welcome to the download. I'm your host, Dave Richardson, and it is Tuesdays. Now, the calendar will say that this is not the last Tuesday of the year, except that it is. So there'll be a couple of more Tuesdays, but there will be no more Tuesdays. And there's a big difference between that, right? Between a Tuesday and a Tuesday, right, Stu?
Yeah, there is. Maybe not to enough people, but to a few people, there's a big difference. And two of
Well,
them, you're looking at two of them.
yeah, I know, and we're working on it. Don't forget to click subscribe wherever you're watching this video or listening to this podcast. Give us a 5-star review. And here's my 5-star review question for you, Stu. I think I know the answer to this, so I'm going to ask: are you a Christmas sweater guy? Do you like to put on the ugly Christmas sweater, or do you like to stay a little more buttoned down like
I'm a little more
you
buttoned
are
down. I'm a
usually?
Chri- I'm a Christmas tie guy. Uh,
Oh,
yeah, I got a couple with reindeers and candy canes. There's definitely a handful of sweaters in my house. Um, but I like to go with the Christmas tie.
the Christmas tie. So that means
Yeah.
but if you got the Christmas tie on, then you got like you have the whole suit and dress
I
shirt and
wish.
tie, and that is like,
Well, often there's a few of those parties where, I said maybe it's just going back to my youth, I was a bit of a gray flannel and blue blazer guy with, Sunday dinner, that type of thing. And then, so Christmas tie was the way you kind of did it up. Now you can have the whole red suit, candy cane suit. You can have them all ordered up on Amazon in no time. But I've yet to do it.
people go all out now. Now, any of these parties that you're at over the holidays where that tie ends up tied around your head at the end of the, because I know you wear the sweatband when you're doing your workouts, but
Yeah, well, when you really get dancing, you do work up a bit of a sweat. So you never know, Dave. You never know.
never know. So again, if you're out and about in the Toronto area, Stu could be at a party near you, and you'll want to get reports on the activity.
Yeah.
And it's always unexpected, as every Tuesdays is. And this was a year of pretty good Tuesdays, because this market, as we've talked about over and over and over again, has just been, really unbelievable. I mean, particularly in the U.S. and concentrated in those areas that we've talked about. And it was fantastic. And then we had the election, which removed some uncertainty, and then it's just gone off to another level. When you look back at 2024 now, because this will be effectively our Tuesdays year in Restu, and we look at 2024. What are your thoughts on the year, and what do you remember 2024 for as a portfolio manager?
Well, yeah, you're always every any good portfolio manager is always looking back on things I did well and things I could have done better. Um, when I look back on the year, it was kind of this rotational market between a heavy concentration around a handful of names that were very artificial intelligence driven, and that would go for a spurt, and then the market would broaden,
Yep.
and people would think the economy is going to get better, and all of a sudden financials and other things would kind of pick up the ball and run for a while, and we kind of had this back and forth through the year. um, and it led to strong returns across many asset classes. When I think about some of the dominant ones, like technology was quite dominant. And I think we'll probably have a lengthy discussion about this one, but I think the thing there that it was not so much the earnings growth, which was healthy. It was the valuation expansion that uh, valuation expansion after valuation expansion that was a little bit harder to have the same degree of confidence in versus the financial stocks, which were quite strong, and they started from a very reasonable valuation, and it was the prospects of fundamentals improving that kind of drove those stocks in the stock market. So, but I think it's relatively some volatility, but relatively benign
Yeah.
movement from the fixed income market, and then this back and forth between narrow market to broader market. And as we finish the year, we're finishing in it a little bit on the narrow market side of
Yeah.
things. Um, And so we'll see as we get into next year. Can it broaden again after the year passes?
It's interesting you bring that up because I think of the year, and we'll get into this in terms of risk exposure and where what were the big winners versus others. But and this is why we do the year in Restu, because we need to go back and think about what was going on. And you're absolutely right, which is no surprise to anyone listening, that there was this kind of back and forth wave. Now overall the steps are going up each time, but there was that concentration. But then it seemed to broaden out, and a different set of stocks. And we talked about going to go back and really here, I think the best encapsulation of where the market's sitting and how this back and forth is going is go back to the podcast, and we'll try and link it in the details for this podcast of the of Stu's three buckets of stocks that we talked about quite a bit thematically through the summer
Yep.
and into the fall, and you really did have this movement around. And again, overall, fantastic year. There are some bigger winners than losers, but it wasn't just as we always remind people, it's never a straight line up for everything, and there was quite a bit of back and forth, along with the yields as well. That your 10-year bond yield that we like to track. I mean, that's been as low as where we get to three. Well, I guess we got to 368 at one point,
Yep.
and it's been as high as 450 through this year, and we're sitting in around 440 again after it just maybe what 3 weeks ago was sitting in around the 410 mark. So it's been an interesting year on the fixed income front, and that kind of reflects, I guess, these movements around between these high flying tech and financials and other stocks that have also done okay.
Yeah, and I think like it's interesting. Like there's a thematic to it, and then the kind of the reason. Like the one of the best performing factors in the equity market was estimate revision.
Yeah.
And we've often talked about like the long nose of the stock market, kind of sniffing things out. And when you get into these types of situations, like the moment something was perceived to be getting better, and that was normally through a small upward revision in its estimate, the stock market just went and just pulled that forward like crazy. Like, we saw Canadian Bank, go up, maybe 8-10% in about 90 minutes, as the perception of the provisions for credit peaking became more apparent. This week we saw, a large semiconductor stock, which might be in the, kind of more exposed to the next phase of where artificial intelligence going. We saw their estimates for, 2027 and 2028 go up by 6 or 7%, and the stock went up almost 25 or 30%. Like the notion that if something gets a little bit better, the stock market says it's going to get a lot better,
Yeah.
and you really wanted to pay forward for it. So as we move between those buckets, and they each kind of had pauses and then new forms of performance, it normally came around some sight line that bucket's earnings were about to improve, and then there was a real spurt that followed it as momentum and kind of chasing those periods of time became quite dominant in the stock market. And of course what we're trying to do is to try and be in front of them, right? So that when they get there. So that's where, like, right now we're in this kind of lull for the average stock. Not really negative performance, but we've been through a period in the last 3 or 4 weeks where we've narrowed in again around not all of the Mag 7, but certainly some of them have kind of been very strong. And some for the prospects of higher estimate revision, some of them from the prospects of the election without necessarily estimate revision. And those are going to be very interesting situations as we move into 2025.
Yeah, forgot about the day after the election. Several bank stocks in the U.S., big and mid-size, were up 10-15%. Again, just on an election result, and there were quite a few of those kind of moves throughout the year, as you say, whenever there was the slightest bit of optimism in that one area, wow, the money just poured that way, and you
Yeah.
saw big moves in that area.
Yeah, like the speed with which people wanted to kind of dream the dream, uh, whether or not there was copious amounts of evidence or not, was definitely a big theme for this year. As soon as there was a sniff that the story was going to migrate to something new, and the farther away it was and the bigger it could be, it was just like it's going to be big, and again, without any near-term evidence, people really wanted to migrate to some of those dreams this year.
So I was laughing with you. Not everyone is a Monty Python fan.
Yeah.
I happen to be a big one. I was actually watching. They had a Monty Python film on one of the channels this weekend. I sit the kids down. The kids actually, 18 and 20, they actually laugh at this stuff, which I think is amazing. Tells you when something's good is when generation after generation
Yeah.
can appreciate it in their own way. But the one movie scene is they've got this big guy rolls into a restaurant, and he's known for overeating, and he eats kind of everything they have. Kind of like, so here's our food analogy. So he's eating up all the risk he can, and then there's one little wafer left that they convince him to eat, and he eats that one little last wafer, and then all of his guts explode all over the place. Sorry to be too vivid, but it was just that one little bit that went from, wow, I've got an unlimited appetite for risk, to all of a sudden I have no appetite for risk. We talked to Marcello about this. We had him on Friday,
Yep.
and just the whole idea of, like, it just kind of feels like the market, at least since the election and at different points through the year, it's just give me more risk, feed me more risk, and if I've done that, I've been successful. I keep getting satiated, but at some point, and is that maybe the theme for 2025, or is this just one of those things where there's so much innovation and so much potential as we move into next year and the next 3 or 4 years, that it's justified?
Well, just along the lines of Monty Python, like the moment when, in that little story, anyways, that better get me a bucket.
Yep.
Trying to predict exactly, when the market needs, the bucket is an interesting one. I think, there's certainly areas where when asset prices go up so much faster than the earnings and cash flow estimates underneath of them, we have to be a little bit wary, right?
Yeah.
Like as the longer term investors, that's really what drives asset pricing over long periods of time. And when we get into these situations where things are very technically driven, there is a lot of enthusiasm for the future. Sometimes the best stories have no evidence in the near term, because then there's nothing to interfere with the dream. We have to be careful around those things, because we know eventually on many of these stocks the rubber hits the road. And the last time we really had a period of like this was probably coming out of COVID, and we had a lot of enthusiasm for some stocks, coming out of that period of time, and valuations were they were consequential in the sense that they were high, but they were inconsequential to the investment decision. And eventually, the delivering of good numbers but not good enough resulted in a fairly significant price change. We've talked a lot about all the things that are on my wall, all the quotes that are on my wall, and we were joking about a few of them before we began. But one of my favorite is Peter Bernstein, who wrote the great book on risk called Against the Odds, which goes all the way back to the starting of insurance and tulips and all sorts of things. But what if I'm wrong? Any rational investment plan has to start with that question. That one is right above my monitor. So right now, there's a lot of enthusiasm. There's not a lot of focus on how it could unfold in a number of different ways. There's one here from Howard Marks, which is: the bottom line on the quest for superior investment returns is clear. You shouldn't expect to make money without bearing risk, but you shouldn't expect to make money just for taking risk.
Just for taking risk.
And so there's always pockets. There's always pockets of enthusiasm that we have to monitor. And And maybe you've participated, in which case you have to, kind of evaluate, your positions in those, and others you haven't participated, and you say, is it too late? And you have to, kind of judge those, fundamentally. And we've talked about in the past, like, investing is saying, I want these cash flows to grow over time to support rising asset prices. Speculation, and there's nothing wrong with it, but it's saying, I'm going to buy this to sell it to someone else. And they're two different toolboxes. We shouldn't really, we shouldn't confuse the two. They're two different skill sets.
Well, I'm going to get people confused with the old guy who's yelling at the kids to get off his front lawn, because I'm out a lot in the fall, doing our event program and speaking to thousands of people across the country and talking to people afterwards, and I'm always talking to advisors about what their clients are asking, and I'm always watching for not just the narrowness in the market, but the narrowness in the questions that I'm getting. So when I think about what people are coming and asking me about in terms of maybe what I didn't cover off enough of in a 45-minute speech, it was gold for a bit. Now that's tapered off. Now it's cryptocurrencies, and it's certainly around U.S. stocks and U.S. tech stocks. And when the questioning gets that narrow, that's when I start to get concerned, because one of the things I know, and from being around a long time, going back to, the 70s, the 87 stock market crash, the tech bubble burst, all these global financial, all these different events that have taken place that are significant in markets, is whenever you get away from that principle of diversification, you may be setting yourself up for some really hard times. And then one of the things that really captures a lot of people when these things reverse, and we've seen several things like Nvidia or Bitcoin or Bre-X gold. If we talk about Canada, well,
Yep.
throw that one in there. Like, just run the list over and over again, all those names through history. Is that a lot of times people get caught in that. It reverses, the momentum's gone, the appeal's gone, and it's amazing how quickly it falls, and it's amazing how often people hang on. And again, diversification is boring. It's not as exciting as watching an investment go up 10% every day. And there's portions of a diversified portfolio that you're sitting there as this risk trade works day after day after day. And you're looking at that piece of your portfolio and going, well, why is that flat again? Why? Like, I hate that. I'm going to sell that and buy more of the other because it's more. And it just, at some point, and really, in a long-winded way, I'm saying this is the argument for stepping back at times like this, taking a deep breath, and falling back to your first investment principles. And I like the thing too, if you have been out a little bit over your skis and you have taken on a little bit more risk than you normally would, hey, great. Maybe extra Christmas present for a loved one, but be wary.
Yeah, and it comes down to your financial plan, and what percentage of, when you get into these types of situations, the degree to which you want to be involved in some of these things. Do you kind of bucket them in your financial plan? You don't let them get above a certain size. The risk exposure is tolerable. These are all pretty important discussions to have with your advisor. I think the thing that, when we make investments, there's a couple of things I always think about. The first is, of course, that rule of 72 in terms of doubling. And, it's the last doubling where I make all my money.
Yeah.
And if I rush the first doubling and I miss the last doubling, that has big consequences on the portfolio. So there's nothing wrong with wanting to partake. It's just, understanding how it all kind of fits in the grand scheme of things. And then the second thing is, there's some investments that, this year has been a good year for many different investments, but some of them I look at and I think, we owned that stock for, 2 or 3 years, and we could see the cash flow it was generating, and we could see the balance sheet improving, and we could go talk to management, and we knew we were going to make money. We didn't know exactly when. And, some of those stocks then go on to like double in 6 months. And if we continue to kind of fill the portfolio, maybe it's a little bit like the old Maytag man. Like, it doesn't look as exciting on the day that you purchase it, but if we continue to fill the portfolio with these long-term positive options, and we think we've bought them at good prices and we've underwritten a degree of risk that provides us some comfort, then when we get rewarded, if it comes sooner, we get a spectacular return. If it comes in time, we get a very good return. Those can be great investments in a portfolio, and they're never the ones that are making the presses around this, that, and the other type of coin and what have you. And as I say, like, there's nothing wrong with that. But kind of bucketing these experiences in your portfolio is usually pretty important when you get into these types of environments.
Yeah, and I want to be clear. I don't think Stu and I, and you can interrupt me if I'm off on this, but I don't think we're saying we're not positive on stocks or positive on bonds. There's, when the Fed goes into a rate cutting cycle, this typically, as long as you don't have a recession, which is driving the rate cutting, it tends to produce pretty decent or even slightly above average returns in the 12 months following the first cut. If we look back at history. However, however, you the importance there is to have that diversification, because if one part of the market already takes that year, like already advances a year in a few days, you want to have some of these other stocks like Stu's talking about that maybe lag a little bit behind and frustrate you in the near term, but as long as things stay positive, they're ultimately going to work out. So it's not we're still very pro stocks and pro bonds but we're pro a diversified portfolio and not over concentrating and getting too much risk and only relying as from your quote, that risk to drive the return.
Yeah, like, it's like, I think back, and it's always hard to say exactly where you are in the spots of the cycle. Um, I've been at the Royal Bank for almost 30 years. I've been buying the Royal Bank stock every 2 weeks, since I started. In 2000, I did use some of my money to buy Vertical Net. I never forgotten it. It was a
Yeah.
business to business, going to be a bonanza, and I think I lost a third of my money in about an hour.
Yeah.
And I remember keeping both sides of the transactions, the buy ticket and the sell ticket, as a bit of a reminder to myself. Obviously I wish it had worked out, but that didn't interfere with my other plans, right? And
Yeah.
so kind of keeping it all together in your portfolio is pretty important. And kind of like the enthusiasm with which you get involved in, the here and now, try and be equally as enthusiastic about, the long-term compounding that can go on your behalf elsewhere.
Yeah. And one of the other things that doesn't really exactly tie into this, but does tie into buying bank stock. Just at a retirement party the other day for a colleague that many of us would have described as one of the few indispensable people we've ever seen inside an organization. And we were kind of joking with him on his retirement that the stock's gone up 40% since he retired. And so again, this is these are big organizations, and it's the big economy and the growth in the overall economy, human productivity, human innovation, earnings across the board. That's what's driving stock prices higher. This is big picture stuff, and you just got to keep it all in perspective over time.
100%, Dave, and it's a great message for this time of year as well, because we're fortunate in what we do and the interactions that we get to have, and so it's a great way to finish 2024.
And I know not everyone celebrates Christmas here, but Stu and I do. And one of the things I learned this year in particular because of the focus, and so this is a new approach. You can try this at home because I'm gonna bet Stu does it. Is I've now I'm giving out gifts. I'm doing what I'm calling dollar Christmas averaging. So I'm giving so this falls in with your dollar cost averaging, Stu.
Yeah.
I'm giving out small gifts all the way through. Like those advent calendars where you get the chocolate every day.
Every day. Yep. Yep.
Every day, I'm giving a little bit more to my wife. The kids maybe they've already gotten enough, but
Yep.
dollar Christmas averaging. There you
It
go.
sounds fantastic. It's very
I do that with the
anti-Grinch like.
puppies
It's
too.
good.
Yeah,
Yeah.
one snack a day all through the year for the puppies. It's all good. So you got a DCA.
That's
And and
priceless.
and again, if you're wondering what gift you got from us this year, well, you got a lot of Stu's days and a lot of dollar cost averaging advice. Stu, thanks again for a great year. I know everyone loves listening to you. I was down in the U.S. I bumped into somebody at a football game in the U.S. who listens to the podcast and said, to be honest with you, Dave, I'm kind of tired of listening to you, but I love that Stu guy. That
Yeah.
Stu's days in my house, just a random guy at a football game. And I know people really appreciate your wisdom, and so thanks for putting up with me and doing this every week, and really look forward to seeing you in the new year. All the best to you and your family.
Okay. Thanks, Dave, and all the best to everyone who listens.